Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul speaks with Ken Esch, a partner at PwC Private Company Services, about the results of PwC's most recent Trendsetter Barometer report on the state of U.S. private companies.
It was good to read almost uniformly upbeat report. I mean, was that sort of your take on it, or did I miss the dark part?
No, I'm excited about the results and the report, and feel like the optimism levels are very high, and they're being backed up by some action in the way of spending and some hiring. So I feel good about the growth trajectory that we're on right now.
There were a few things that sort of jumped out at me that I was wondering what your thoughts were on. And I think I've asked you this kind of question before. That I always take a look at sort of the domestic versus international, outlooks, because I've always found that to be somewhat intriguing. Here in the U.S., we've got a pretty low growth rate, still do, and some of these markets overseas, the Eurozone not being one of them, but other markets overseas, have these rapid growth rates, and it's always intriguing to me to look at the different perspectives, these domestic companies that do business overseas, their perspective on the relative strength of the economies and growth opportunities. One of the things that jumped out at me was there's this overall more negative view of international economies relative to the U.S. Among the group that you spoke to, and yet the folks overseas have more optimism with respect to revenue growth, which I thought was interesting. And I guess later on in the report, there was a sense that even with their less optimistic view of international economies, their capital expenditures overseas are increasing faster than, or expected to be greater than, in the U.S. So there seems to be something of a dichotomy there. I mean, what do you think about that?
Yeah, there's a lot of interesting tidbits of information, with respect to these international companies. I guess the first one that you identified is that the Trendsetter survey participants, are much more optimistic about the U.S. economy than they are about the world economy. But if you dig deeper, one of the things that I enjoyed reading was that the number of participants who were pessimistic about the domestic economy was about the same as those who are pessimistic about the world economy, both in that 5% type of range. And where you get the difference is really the number of participants who are uncertain about the world economy versus those who are uncertain about the domestic economy. So when I look at this and talk to clients, I think that the pressures from Europe still weigh on them. It appears that we're in a slow growth economy there. Perhaps cooling in China and Brazil affects their view about the economy, but it's not really changing their plans to grow, because they know and believe that over the long term, the economies and the purchasing power of economies is going to shift from west to east and probably north to south, and to get the growth that they're trying to achieve, they know that they need to be in high growth markets. And even though they may not feel as optimistic about those global markets relative to the U.S. economy today, over the long term, they believe that the growth opportunity is better there.
Another thing that struck me, and this kind of goes to the broader question. It was true in the international side, and you were talking about the plans for capital expenditures and that sort of thing. The whole capital expenditure thing struck me as interesting, that in really two ways. One, the concern about funding being available, which I was very surprised at that, and just because there does seem to be so much money sloshing around on the sidelines right now. But presumably the reason that they are concerned about sufficient funding is perhaps credit availability in terms of the more stringent credit requirements. I don't know. I thought that was surprising to me. And then I guess the second part of the capital expenditure bit was that the rate of expected capital expenditures seems to be declining. I mean, I think your report actually identified that,
right.
Which was, I mean, that almost tells me that there's, well, I don't know. I'm not sure what it tells me. It could be, is it because they're chastened in terms of getting burned over the when the recession hit? I don't know. I mean, what do you think about those two things?
Well, maybe first, I did read the concern about the lack of capital for investment with a little bit of surprise. It's inconsistent with what I see with clients today. Inconsistent with what the survey participants are telling us about the interest rate environment, which they tell us that their borrowing costs are in the 3.5% type of range. So really low borrowing costs, which we see in the overall economy. That we do see continued investment, particularly with companies that are expected to grow their business at a rapid pace. So while this lack of capital for investment did creep upward and was an outlier compared with the other barriers to growth identified in the survey, I think it's too early to declare it a trend. We're still kind of down in that 20% range, which has been consistent over the last year. So we'll continue to watch that one closely, but I think it's a little bit early to call that a trend. It
was good to see, I guess, that the list of barriers to growth, they all went down from a year ago,
right.
Which that's pretty amazing. I mean, if anything shows confidence, I guess that does.
Yeah. Well, I don't recall that ever seeing that in the last 4 or 5 years that I've done this done this report. But the one that I have watched closely is lack of demand, which is consistently at the top of the list for barriers to growth, and that dropped over the last year from 66% down to 53%, which is telling us further that the companies have moved beyond trying to get a customer to buy and are now more focused on how do I reach that customer to help increase my sales.
But if there's a positive outlook for the overall economy, that's it, isn't it?
Yeah, I mean the other ones that I was looking at were concerned about regulatory and legislative pressures, and concerned about increased taxation. Both have dropped 8 to 10% over the last year. I think with things being a little bit quieter in Washington, that companies feel like the regulatory legislative areas are stable for now, and that they're much less worried about those areas.
Yeah, that was actually my next question. Maybe gridlock is good.
Yeah, right. I think that a lot of companies that we work with are just looking for some stability and not introducing too much change, because it distracts them in some ways from their growth agenda.
So it's not necessarily rolling back anything at this point, although I'm sure that would be appreciated. It's more like just don't throw anything. No more curveballs. I'll deal with the environment as is. Yeah.
Right.
Yeah, I wonder how that's going to be impacted by the president's climate agenda that was announced yesterday. Well, we'll see. Another curveball. Boy, the hiring thing is also, I don't know. If there's a worrisome, for me anyway, if there's a worrisome note in this whole report, which again was overwhelmingly positive, it's the hiring component. And I think the reason that I identify that is that while a large number of companies are planning to expand their employees, the composite was only 2%. I mean, that suggests to me that this is really targeted kind of hiring, right?
I guess the report is not showing we're going to have significant increases to that composite workforce. That is different than what we've seen in prior recessions, where we've really seen snapback of hiring following a recession, and that's just not happening with this one. if there's good news, in those numbers, we are seeing a significant majority, 63%, that are planning to hire, and that has been growing, and it's been above 50% over a year now. So while we may not have real significant additions to the composite workforce, a larger number of companies are expected to add them, and they are adding targeted areas where they feel that the additional people will drive top-line revenue growth and profitability. So we're seeing things like sales and marketing to help find an additional customer or crack into a new territory. We're seeing hiring in the areas of IT, where we can streamline processes and analyze our data, to predict buying habits, of our customers and try to help grow the top line again. But we're also seeing areas in the, I'll call it blue-collar labor areas, where we're continuing to see companies, build some additional manufacturing capacity in the U.S. and trying to hire qualified workers to fill those positions.
I believe it was in the growth barriers. The worries about qualified workers has pretty much stayed the same, so that hasn't lessened any, has it? With 29%. No. Yeah, right. I keep seeing more and more data points on that.
Yeah, and it's while it's stayed about the same with respect to the number of companies that are identifying it as a barrier, in virtually every conversation I have with a client about growing their business, that's a topic that comes up. And it's really across the board. It's in the some of the professional ranks. It's in some of the sales and marketing areas, and it's at the factory floor level and distribution house employees that they're struggling to fill open positions. And companies are taking some bold moves. In that area, doing things like first, retaining the qualified workers that you have. You don't want them walking out the door as the labor markets gain some additional velocity here. And then they're also developing internal training programs to help assimilate new hires into the workforce and make them productive as quickly as possible. So taking those experienced workers, developing some programs to help train new hires so they contribute immediately. And then perhaps the third area is where companies are going out to some community colleges and trade schools to help develop a curriculum, to develop the necessary skill sets, and find individuals who have baseline qualifications and a desire to work in these companies. So they're taking some bold moves to help reduce the impact of a labor force that in many cases has been out of work for years. And some of those skills are just stale and need to be refreshed for an economy that is much more dependent on technology than it's ever been.
Be sure to check back for future episodes of the President and CEO Focus on the Middle Market podcast series. Thanks for listening.